Something extraordinary happened in the oil market this week. After weeks of fears that the Middle East could trigger the biggest energy crisis since the Ukraine war, oil prices suddenly collapsed again. Brent crude, the global oil benchmark, fell below $88 a barrel. West Texas Intermediate dropped towards $82. And in a single session, oil suffered its biggest decline in more than 3 months. Why? Because President Donald Trump announced that the US and Iran were entering negotiations. After weeks of military escalation since the end of June, missile attacks and fears that the Strait of Hormuz could remain blocked, markets suddenly began pricing in peace. But here's the question, is this a genuine turning point, or is the oil market celebrating too early? Because beneath the headlines, the reality is far more complicated. The Strait of Hormuz, the narrow waterway through which roughly 1/5 of global oil supplies normally travel, has not fully reopened. Iran has not abandoned its ability to pressure global oil energy markets, and Saudi Arabia's most important oil facility has reportedly come under attack. So today we're going to break down why oil prices collapsed, what Trump's Iran strategy really means, why a bigger military escalation remains possible, and the one event that could send oil prices from $88 back to $120 almost overnight. So, firstly, why did oil prices collapse? The oil market moves on expectations, and right now, traders are betting that the Iran crisis may be moving towards diplomacy rather than a prolonged war. Trump said he paused further strikes against Iran to allow negotiations another chance. He suggested there was a good chance talks could make progress. That single statement dramatically changed market expectations. For weeks, traders feared the worst: Iranian attacks on regional infrastructure, a complete closure of the Strait of Hormuz, disruption of Gulf oil exports, and a possible global energy shock. But suddenly, investors began asking, what if this crisis ends? And that changed everything. Oil prices had already risen sharply earlier this month because markets feared a major supply disruption. But when those fears began fading, traders rushed to sell. This is why Brent fell almost 10% in one day. However, there's one important warning. The oil market may be moving faster than reality because while prices are falling, physical oil flows have not fully recovered. That's the Strait of Hormuz, and this is the real test. The biggest issue facing oil markets is not what politicians say, it's what ships actually do. The Strait of Hormuz connects the Persian Gulf with global markets. Every day, millions of barrels of oil and LNG normally pass through this narrow waterway. If the strait operates normally, the market relaxes. If the strait remains disrupted, prices can explode. And right now, traffic remains far below normal. Data showed that only a handful of vessels crossed the strait during some periods, possibly less than 5 per day. Some ships appear to have moved without broadcasting their locations. This tells us something important. The market is hopeful, but shipping companies are still very cautious and risk-averse. One energy analyst summarized the situation. The Middle East is not solved. The market needs to see real evidence that oil is moving freely again, and that has not happened yet. So what is Trump really trying to do? This is the biggest question. Why did Trump pause the strikes? There are two possible explanations. The first is diplomacy. Trump may genuinely believe that Iran can be pressured into reopening the Hormuz via negotiations. The second possibility is more strategic. The pause may simply be in preparation for a much larger military operation. Because previous US strategy, limited daily strikes, may not have achieved its objectives. The goal of the strikes was not just to damage Iranian military assets. The main objective was forcing Iran to reopen the Strait of Hormuz. But after weeks of limited attacks, Iran still has not fully reopened the waterway. This creates a strategic dilemma. Does the US continue limited strikes that achieve little, or pause, rebuild resources, and prepare for a much larger campaign? This is why some analysts believe escalation remains possible. The US still has military options, Iran still has leverage, and neither side appears to be weak. Why Iran may not give Trump the deal he wants? The biggest obstacle is the Strait of Hormuz itself. Iran's position is clear. It believes it has influence over the waterway. Tehran wants any agreement to recognize its role, but the US rejects that idea. The US believes freedom of navigation cannot and will not depend on Iranian approval. This is the central disagreement. Iran wants influence over shipping, reduction of US military pressure, and recognition of its regional role. But the US wants free navigation, no Iranian veto over shipping, and reduced Iranian leverage. Do you see what's happening? Both sides are still far apart. Oman has been trying to bridge this gap, but the difficult question remains unresolved. Who controls shipping access? Who guarantees safe passage? What happens if Iran disagrees with the vessel crossing? Until these issues are resolved, the crisis remains unresolved. The Saudi Arabian oil threat is much, much bigger, but nobody talks about this. Markets are celebrating falling oil prices, but another story deserves much more attention. Reports are emerging of a possible attack near Saudi Arabia's Abqaiq oil facility, and this is potentially one of the most important energy risks in the world. Why? Because Abqaiq is not just another oil facility, it is the heart of Saudi Arabia's oil system. The facility processes more than 7 million barrels per day. To understand the importance, a successful attack on Abqaiq could remove a huge amount of global supply overnight. This constitutes roughly 70% of Saudi production per day. There is no easy replacement. Spare capacity elsewhere cannot immediately compensate, and this is exactly why the market may be underestimating the risk. In 2019, attacks on Abqaiq temporarily removed millions of barrels from global supply. Oil prices surged. The lesson was clear. You do not need to destroy the entire facility. Damage to critical equipment can create months of disruption. And Iran and its regional allies had demonstrated both the capability and willingness to target such Gulf energy infrastructure. But the one difference that happened overnight yesterday versus 2019 was that the attacks yesterday were conducted by Iranian proxies in Iraq. These proxies fired drones at the Abqaiq facility, drones which were crude and were able to evade radars and interceptor missiles. So, where do we go from here? There are three possible scenarios. Scenario 1, diplomacy succeeds. Here, Iran agrees to reopen the Hormuz, shipping returns, oil supply normalizes, and prices can fall significantly. But we don't see this happening. Scenario 2, a continued stalemate. Neither side escalates, negotiations continue, ships slowly return, oil prices remain very volatile. This could happen, but it also seems a bit remote. But scenario 3 is one of escalation. Talks fail. The US increases military pressure. Iran responds through regional proxies. A major Gulf energy facility is attacked. This is a scenario that could transform the market. Oil could quickly move back above $100, and if Hormuz remains blocked, those numbers could become much higher. This is the scary but most realistic scenario right now. So, what do we make of all this? The biggest mistake the market makes during geopolitical crises is assuming that the first sign of optimism means the crisis is over. Right now, oil markets are pricing in peace, but the physical reality tells a different story. Hormuz has not fully reopened. Iran still has leverage. the US still has military options, and Saudi Arabia's energy infrastructure remains very, very exposed. The next few weeks could determine whether this becomes a historic oil sell-off or the calm before the next energy shock. If you want deeper analysis of global energy markets, geopolitics, and the forces shaping oil and gas prices, subscribe. Because the next move in energy markets may not come from a trading floor. It may come from the next decision made in Washington, D.C., Tehran, or even Riyadh. Thank you.